Yahoo Finance Live. In this week's Yahoo U, we're digging into a controversial issue as a show that hosts a lot of stock pickers, maybe why stock picking might not be the best strategy, and a debate among active and passive investors. And here to break that down in Yahoo U is Brian Cheung. Brian?
Well, hey, Zach, I'm kind of blindsided by what Jared had to say about that Bill Smead comment on active versus passive. But let me walk you through all of this because, of course, school never stops. So class is in session. And the biggest question in playing the stock market is often, is this play worth the investment? But in the great debate of active versus passive investing, the question is really, is it worth the effort? Now, let me explain. So first off, the obvious, right? Active investing is a strategy where you're actively or cherry picking the stocks in your portfolio. So, by the way, this also means more than just having a Robinhood account. This would account for wealth managers or investment managers, basically anyone that builds portfolios. Whereas passive, that's just buying the whole pre-picked basket at the farm, right? The whole market, the S&P 500, for example. Now, I want to remind everyone that it doesn't always have to be the whole market. So there are exchange-traded funds that target sectors like, for example, U.S. large cap stocks or corporate bonds. That would count as passive investing too, so important to keep in mind. Now, in general, these are the pros and cons of each investing strategy. Now, if you're picking individual stocks, you have more flexibility than you do with buying the whole market. And the big draw and the upside of being able to beat the market is really the big pull for active funds, right? Obviously, if your strategy is just owning the whole S&P 500, you can never, by definition, beat the S&P 500. Now, the upside of passive on the other side of things is that it's much cheaper. So it's not free. Buying an ETF does come with a management fee and expense ratio, but it's going to be a few basis points. In some cases, maybe just 5 basis points. But compare that to hiring an active manager. That could run you 200, 300 basis points a year. That's a pretty big difference. And then there's also transparency, right? If someone is day trading for you, it's going to be pretty hard for you to keep track of where your exposure is at any given point in time. Whereas if you're passive, you buy the whole thing and you sit back and you relax, you can see exactly what's in that ETF that you're holding. So the question, of course, here is which one's better, A or B? Well, a reminder that it's all relative. So this has been the S&P 500 over the last 5 years, and you can see the trend, right? Stocks go up. Now, if you were cherry picking, the question is not if you made money because of that. The question is whether or not you beat the market or if you underperform the market. So the question is, let's look at the numbers. How many active funds beat the market? And this right here is the answer. Among active funds that were looked at by Morningstar, only 42% of all U.S. stock funds were able to beat the market in 2020. That was the worst circle that I've ever drawn, by the way. But it's the same story if you break down all U.S. stocks by market cap. So less than half, 45% of funds that are targeting small stocks beat the market, only 46% for mid-cap stocks, and then only 38% in large cap stocks. And by the way, this is where the Tesla, Facebook, big name stock fund managers are. And underperformance by active funds have been a trend over, the last 15 years. Data comes from Bank of America Global Research, and it shows that trillions have flown into passive strategies for investing. That's the blue line. Whereas trillions have flown out of active funds, the purple line. And again, this is U.S. equity specifically. Keep that in mind. And it's important to note that this dynamic hasn't always been the case, though. So active fund managers, which would have been the purple line, were all the rage in the 80s and the 90s. But again, this is U.S. equities, and I want to point out that there are places right now where active investing is successful. So check this out from Morningstar. Maybe this is what Bill Smead and Jared Blickery were talking about here, but active funds did much better in these categories. So more than half in each of these 4 that I'm showing you. About 70% of active funds in diversified emerging markets outperform their passive competitions. And take a look at this. Real estate, 71% of active funds, 7 in 10 that were playing in that market ended up beating the passive competition. So I want to point out that there is a place for active right now. It's just not in U.S. stocks. And here's the bottom line that I want to point out. There are definitely clear trends in investing versus passive versus active investing. But all of this is to underscore how difficult it really is to beat the market. I mean, some of our viewers might be casual players in Robinhood, And my take is that even if you don't outperform the market, if you had fun while you were doing it, there's some value in that right there as well. And that wraps up this week's Yahoo U. Zach and Kiko.
Fun while you're doing it. Try telling that to people who've lost some money in some of these funds. But Brian Cheung, great as always. Appreciated that lesson there.